Today, we're cracking open the engine of wealth itself. We're going to explore a concept that is absolutely fundamental to all growth: fixed versus circulating capital. So let's get right to it. Here's the bottom line, what you really need to know. The principles that build a multi-million-dollar portfolio are the exact same ones that build a nation's wealth. And it all boils down to one single thing: how effectively you reinvest your surplus. Welcome to the MoniLytics channel, where money meets research. All right, so to really understand how this engine of wealth works, we first have to take it apart, deconstruct it into its two core components. And this idea, well, it's not new. It goes all the way back to the father of modern economics. That's right. Adam Smith, in The Wealth of Nations, laid the entire groundwork for this. He saw that capital isn't just one big monolithic thing. No, it's employed in two fundamentally different ways to generate a return. And getting this distinction, it's the absolute key to understanding how growth actually happens. So, what are these two forms? Well, first, you've got fixed capital. Think of this as the solid, durable part of the engine. It makes you a profit, but it stays in your possession. On the other hand, you have circulating capital. Now, this is the fuel. It only makes you a profit when you actually part with it, when it circulates, when it gets exchanged for something else. Let's make this a little more concrete. When we talk about fixed capital, we're talking about things like the machinery in a factory or commercial buildings. And what I find really fascinating is that Smith even included acquired skills, what we now call human capital, in this category. Now, circulating capital is all about motion, your inventory of products, the raw materials you buy, and, of course, the cash you use to pay wages. Okay, so these two parts, fixed and circulating, they don't just sit there. They have to work together in this really dynamic system, a powerful process that actually creates value. This is the circular flow. This is the engine in operation. So the circular flow is basically a continuous loop. You put capital into the system, it goes through the production process, it comes back to you with a profit. And now this is the crucial part, it gets put right back in to start the cycle all over again, fueling an even bigger cycle next time. This slide here, it breaks down that loop perfectly. Think of it like a flywheel for growth. First, you advance your capital. You're buying materials, paying wages. Second, that capital creates a product. Third, you sell it and you get your gross revenue back. Now fourth, and this is the step that so many people overlook, you must maintain your capital stock. You have to replace what you used up. And finally, step 5, the most important step of all. You reinvest the remaining surplus, your net revenue, to make the next turn of the flywheel even bigger. That right there is the secret to growth. And this brings us to a really critical distinction, the difference between your total returns and the actual surplus you have left over to grow your wealth. This is where so many businesses, and investors for that matter, get it completely wrong. I mean, think about it this way. If a food truck brings in $1,000 in sales, but it's spent $200 on ingredients, gas, and supplies for the day, did it really make $1,000 in profit? Of course not. That $200 isn't income, it's capital maintenance. Smith's framework shows that the price of any product is really made up of 4 parts. 3 of those parts become somebody's income. You've got wages for the worker, rent for the landlord, and profit for the capitalist, the owner. But that 4th part, capital replacement, well, that doesn't become anyone's income. It has to go back into production. It's simply the cost of keeping the machine running. Without it, the whole thing just grinds to a halt. So the crucial point is this: gross revenue is your top-line number. It's the big, impressive figure. But net revenue, that's what's left after you've paid all the bills and fully maintained your capital. That net revenue is the only, and I mean the only, true source of real wealth. It doesn't matter if you're growing a personal portfolio or a national economy. And what's amazing is that this logic, this whole idea of capital maintenance and net revenue, it doesn't just apply to a single business. It scales up perfectly to the level of an entire nation. The principles that make a millionaire's portfolio are identical to the ones that build national prosperity. So first, let's talk about something called dead stock. This is any capital that's just sitting idle. You could think of it as cash stuffed under the mattress or money sitting in a zero-interest bank account. It is not part of the engine. It's sitting on the sidelines, producing absolutely nothing. And the opposite of that, of course, is active stock. This is the capital that's been put to work. It's the money that's been converted into machinery, raw materials, and wages. It is the capital that is actively fueling that circular flow engine we talked about, all with the purpose of generating a future return. So for a whole country, just like for an individual investor, real wealth isn't measured by gross output. Not at all. It's measured by its net revenue, by the surplus that it successfully moves from being unproductive dead stock into productive wealth-creating active stock. This all leads us to the final, crucial step, the actual decision to reinvest. And as Smith argued, this isn't just a personal choice you make with your money. It's an act that actually benefits all of society. I mean, the entire game of economic growth boils down to this really simple formula. If you want to make sure that next year's output is bigger than this year's, you have one option and one option only. You must reinvest this year's net revenue. Every single dollar of surplus that's spent on consumption instead of being reinvested is a dollar of potential future growth that's lost forever. Now, this is one of Adam Smith's most powerful and, frankly, most controversial lines. The person who spends their surplus on fleeting luxuries is, from this purely economic view, an enemy of progress. But the frugal person, the one who saves and reinvests that surplus, they are a public benefactor because their actions are what fuel the engine of prosperity for everyone. So we're left with a final question to think about, whether you're managing a nation's treasury or just your own portfolio. Is your capital an active engine driving future growth, or is it dead stock, just waiting to be consumed? The answer to that question really does determine your financial future. If you found this research valuable, please like the video, subscribe to MoniLytics, and check out the affiliate links in the description to support the channel. And stay tuned for our next deep dive where we'll be shifting our focus to Adam Smith's warning, the 3 things the state is actually for.